Okay, so gold has had a historical run throughout 2025 and into early 2026. The backstory behind this is that when people get nervous and there's fear, uncertainty, and doubt in the markets, whether it's about politics, wars, or about the literal value of money itself, they buy gold as it's the safe haven asset. And 2026 kicked off with a lot of fear, uncertainty, and doubt catalysts that were priced in back to back. We had Trump testing his relationships with allies. We saw this with the threats to take over Greenland and the tariffs with Canada. I remember seeing this on social media at the time due to the Canadian tariffs imposed by the US, and a lot of US products were actually being boycotted by Canadian consumers. If you were, on social media at the time, you would definitely seen it as well. We also had central banks around the world buying gold at record high levels, as well as the US dollar getting weaker and consolidating at yearly lows. And we can see that with this article here. So this was January 25th. So that was at the literal peak here on gold. So January 25th was this candle right here. Well, it was on the weekend, so it was between these two candles right here on the daily chart. The precious metals surge comes as recent flashpoints from Greenland and Venezuela to the Middle East underscore higher geopolitical risk, reinforcing gold's appeal as a hedge against uncertainty. Putting all that together, and gold rose from around $2,600 at the start of 2025, so that is all the way back here. Right around here, you can see about $2,600. Up to January 2026, and it was about $5,600. This is the peak right here, right in January, right at the end of January. And then late February 2026, the US was dragged by Israel into a military conflict with Iran. Now, the main thing that I saw a lot of people online getting wrong about gold at this point in time was the idea that war should automatically make gold go up. As, like we just covered previously, fear, uncertainty, and doubt in the markets makes big money rush to safe havens, which includes gold, but that clearly isn't what happened with this massive downside move here. This was because the conflict wasn't just a normal conflict between two countries. This conflict involved the Strait of Hormuz, which, if you didn't know, is this narrow strip of water just off the coast of Iran, this literal narrow strip right here. And if you were looking at your news feeds at the time of this conflict, you would have seen that Keshem Island was a major target for a lot of US strikes. Now, within the Strait of Hormuz, a huge chunk of the world's oil ships go through every single day. When that got disrupted from this conflict, and there was a dual blockade in place enforced by both Iran and the United States, oil prices spiked past $110 a barrel, which I will show right here. So yeah, this was the cause of this initial spike right here, when almost to $120 a barrel. And of course, expensive oil means higher inflation, which means everything gets more expensive. You would have noticed this earlier this year when petrol prices went up. Now, this brings us onto the next point of what higher inflation actually means for the economy. So this downside move here, this is the actual moment gold started crashing, and it comes down to one institution, which is, of course, the Federal Reserve. And if you don't know what the Federal Reserve is, it's basically the US central bank that controls borrowing rates. So on March 19th, which is this candle right here, this daily candle, this massive downside move, with oil prices spiking and inflation fears rising, the Federal Reserve needed to make a decision, either cut rates to help the economy or hold firm to fight inflation. And of course, they chose to have a more hawkish tone due to the energy crisis caused by the dual blockade in the Strait of Hormuz, and the higher inflation reports printed because of that catalyst. I can show you this article here, the Hormuz shock, gold and silver plunge as energy crisis ignites hawkish pivot. The catalyst for the market chaos was a series of Iranian attacks on key energy facilities in Qatar, Saudi Arabia and Kuwait, an apparent retaliation for Israeli strikes on Iran's South Pars gas field the previous day. And this is what flipped the standard gold trade, and why there was a bit of confusion at the beginning of the downside move, as instead of the usual war equals fear, uncertainty, and doubt, which means to buy gold, it became war equals inflation, which is caused, like we just said, by the dual blockade and the energy crisis, which equals higher rates, which actually means to sell gold instead of buy. Now, from April to June, so from here to pretty much where we're at now, we're just in beginning of or early July right now. We saw a continuation of the bearish downside move due to several factors. So this whole move right here. Obviously, it's just the continuation of what we just discussed, the dual blockade in the Strait of Hormuz. Every week, we saw the Strait of Hormuz stay blocked on both sides with either 0 vessels traveling through or a handful of ships that had been pre-approved. Oil stayed expensive, and the Federal Reserve had another reason to stay hawkish instead of cutting. We also saw bond yields climbing. I can get that chart up right now. Throughout this time, so from April through to June, so that's from here to pretty much where we're at now, we saw bond yields climbing. And a side note, if you don't know what the bond yields are, it's basically the rate the US government pays to borrow money. So yields were elevated, and when yields are higher, gold looks even less attractive by comparison. And we can see from this article here, Treasury yields dollar weigh on gold amid inflation concerns. Benchmark 10-year US Treasury yields were near a more than 1-year high, while the US dollar strengthened. Both rose as investors eyed a possible hawkish shift by the Federal Reserve to curb energy-driven inflation. And that leads us on to my next point here, which was the dollar getting stronger. And obviously, because gold is priced in dollars, so a stronger dollar makes gold more expensive for buyers using other currencies, which cuts demand. And then going back to our gold chart here, on June 19th, so that is this candle right here, this bearish candle. I'll just keep the line on that one so you guys know where I'm talking about. On June 19th, that was the Fed's first meeting under the new chair, Kevin Warsh, who came out a lot more hawkish than expected. He didn't waste any time and got straight to the point, saying inflation was high. At this time, almost half of the Fed's own policymakers said they now think a rate hike might be needed this year. That sent gold to fresh 6-month low, which is right here. Reached that on the 24th of June, alongside a temporary Iran deal/ceasefire, which came a few days later after the initial Fed meeting. Now, on July 2nd, which is this bullish candle right here, not too long ago, the June jobs report came out, which was very weak compared to expectations. The US only added 57,000 jobs, which was way below the roughly 113,000 expected. Now, weak jobs data usually spooks the stock market, but for gold it actually helped, as a weaker job market actually makes it less likely the Fed will need to hike rates to cool the economy down. So less chance of a rate hike means gold becomes a more attractive asset again. And you can see here July 2nd, when the jobs report came out, we actually jumped more than 2% that day, I think. Yeah, 2.81%, so almost 3% that day. And it's had its first positive week in over a month. I've got an article here to show that. Gold gains more than 2% after weak US payrolls report. The lower than expected jobs number portends to less likelihood of potential rate hikes later this year. As we know, gold has a tendency to perform better in lower interest rate environments. And then that brings us on to today and current price action we can see here. So what we're actually beginning to see right now is more optimism in the markets at this current time. We've got the dual blockade being disbanded on both sides, the Strait of Hormuz seeing more vessel traffic being allowed through, and there's this nice website here that actually shows current traffic in the Strait of Hormuz. We can see here we've got 34 ships transiting through the Strait of Hormuz, which is a lot higher than when it was closed. When it was closed, we're seeing between 0 and 5 ships transiting per day. And although 34 is a high number, it's not near to what usual vessel traffic is, which is 60. It's still a lot better than when it was fully closed, but it's still not all the way there yet, but it is an improvement. On top of that, inflation concerns are lower. We're seeing the head of the Federal Reserve, Kevin Warsh, coming out with headlines saying inflation is coming down. He said expectations of inflation over the first 4 weeks have come down, and that inflation risks have come down. Now, do bear in mind that this is coming into the US midterms, and a lot of this optimism that we're seeing will be Trump trying to save face and be more diplomatic in order to win over the public. I'll continue to look at whether this optimism holds, or if wartime escalations are back in play and we see more inflows into the dollar and out of gold. I'll make a whole separate video on the current situation in more detail. So just to recap, in January we had gold hit record highs on fear, uncertainty and doubt catalysts. Late February the war breaks out and oil spikes. I didn't actually show the oil chart here, but yeah, oil spikes. Actually, I think I did show that at the beginning. March we've seen the Fed refuse to cut rates, prioritizing inflation fighting, causing gold to crash and have this massive downside move here. From April throughout to June, we're seeing the war drag on. Yields are climbing. Yields was the chart that I did not show. Yields were climbing and the dollar strengthened as well, which carried on to gold just having this big downside move. June 19th was the Federal Reserve meeting that we talked about. In July, we had the weak jobs report, which gives gold a small bounce, and then currently we're seeing more bullish moves due to market optimism.